Hey, everybody, and welcome back to another episode. I'm your host, Brandon Cobb with HBG Capital, and I've got Tom Dunkel on the show today. Tom has been in the game since 2006. He's raised over 65 million in private money across self-storage, short-term rentals, and distressed mortgage debt. Prior to getting into real estate, he worked in mergers and acquisition, assisting to closing over 1.2 billion in deals across the aerospace, IT services, and software and logistics sector. He's done a ton of stuff. I'm excited to jump into him and his story today, as well as why he's really focused on self-storage. Tom, welcome to the show.
Hey, Brandon, buddy, it's great to be with you and all the listeners today. Looking forward to our chat today.
Yeah, this is going to be fun. For those that don't know you, give us a high level. What's your story?
Sure, buddy. Well, I'm solidly in my 50s at this point, so I get very long-winded if I'm not careful. So I'll try to keep it punchy because I know, we just want to get to the meat of things. But yeah, I came out of business school, got into the aerospace industry, doing mergers and acquisitions, which was awesome because it really gave me a great foundation for doing deals, arranging debt financing, arranging equity financing, working with private equity firms. I was surrounded with some amazing people, Harvard MBAs, Wharton MBAs, ex-fighter pilots, astronauts. So it was such an amazing environment. So I really learned a lot there. But fast forward 2006, I was at another company and I ended up getting fired. So 2006, I kind of abruptly decided like, hey, this was the kick in the pants I needed to go and do what I had been wanting to do, which was do something out in the world on my own as an entrepreneur. And so I have a little real estate in my DNA. I guess it skips a generation because my parents weren't really into real estate, but my grandparents that were into real estate and lending and stuff like that. So I got into real estate 2006. Not the best time to jump in. So I got my butt whooped pretty good those next few years as the Great Recession kind of took the market down. But it was through that adversity that I found distressed mortgage debt and connected with my partner, Joe Downs. We started a company called US Mortgage Resolution in 2010. And so for the past 14 years, we've been buying distressed debt. We've generated over $56 million of revenue in that business over that time
Wow.
period. So that's done really well for us, but it's a very volatile and very unpredictable kind of industry. So along the way, as we had some success and we had some extra money to deploy, we started looking at other asset classes. So we started doing some hard money lending. We got involved with a title company. We picked up some short-term rentals. But we really were excited when we started learning about self-storage. And so I'm sure we can get more into that during our chat today. But yeah, to this point, Brandon, we've acquired 16 facilities across 8 states. And yeah, we're just really excited about the self-storage industry, especially in today's kind of iffy economy.
What I love about you is you've got this unique background. You've done a lot and you've been involved with very specific sectors in the real estate field. And so I'm excited to get some perspective on each from you because a lot of people get into this and they say, oh, I just want to invest in real estate. And then they realize, oh my God, there's commercial and multifamily and residential and hard money loans and private lending. And it
Sure.
can just going down the rabbit hole is very time consuming. And so
Mhm.
I'm excited to be able to kind of touch on each of those as well as, while you're, seeing an opportunity in self-storage because
Mhm.
opportunity pivots, right? The market will
Yep.
highlight certain assets to do better than the others. And so investing in real estate, you really need to be able to pivot and kind of know
Mhm.
when and where to move the money. Take us back to 2010. You started investing in
Mhm.
distressed mortgage debt. Best time to probably invest in that. Like, wow. How did you see the opportunity? What was it that was drawing you at the time to that specific asset class?
Sure. Yeah, that's a great question. I guess I learned, Brandon, from '06 to 2010 because I was doing residential stuff. I was doing fix and flips and picking up rental properties and doing some wholesaling. And I guess I realized during that process, I wasn't really great at that. And I wasn't really taking advantage of my skills that I had developed in my corporate life. So when I started going to the investor networking events, just seeing what other people were up to, I started hearing people that were from people who I admired and respected that were getting into distressed mortgage debt. So I kind of dipped a toe into it. With the few bucks that I had left over, I bought a couple of reperforming mortgages, and I just started getting these payments every month. I was like, okay, I think there's something here. So I think it married up for me my experience in corporate finance and then also my interest in real estate. And so having those two kind of roads merged together in distressed mortgage debt, it just kind of the light bulb went off for me. And when I kind of ran it by Joe Downs, who I had met at one of these distressed mortgage debt or at a investor meetup, he was like, "You're crazy, man." I was like, "Hey, you're a smart guy." He had just come out of the commercial real estate industry. He was raising money for 1031 exchanges and things like that. And so I said, "Hey, you go check this out, and we'll come back here and meet at the bar in a couple weeks and let me know
Yeah.
what you find out." So sure enough, he goes out, he does some due diligence, he goes to a couple meetings to meet some of these guys. We meet back up at the bar a couple weeks later, and he's like, "Hey, I think you might be onto something here." And we literally flipped over a paper placemat at the bar, and we started sketching out our business plan on the back of the paper placemat.
Huh.
So, so now, yeah, so now I think, Brandon, one door closes, another door opens. I think as an
Yeah.
entrepreneur, you need to keep your eyes open and be able to pivot and, take a little chance here and there. A calculated risk. You want to do your homework and meet with the people and not jump in really whole hog. But you want to get smart and surround yourself with the right people and try to find those niches that seem to line up with your skill set, your interests, and that might have a future.
And how has that business done, since 2010? Like I said, one door
Mhm.
closes, another opens. That door opened at the time, but I'm
Mhm.
assuming I'm just gonna put words in your mouth here. I'm just guessing that there's not as much of that. There's not as much opportunity there because there's not as much distressed mortgage debt anymore. Is that right?
Yeah, that's a fair point. So it's definitely an up and down, pretty volatile industry, which I mentioned earlier. So for example, we went I want to say like from 2012 maybe to 2014, 15. We went a long time without a lot of product out there. There were a lot of new regulations that came out, making it harder for banks to sell their distressed debt out into the world. And so that really dried up for us. But then around about 2016, 2017, not to get political, but the administration changed
Yeah.
and the regulations got looser. And in 2018, we really had kind of a life-changing year because we basically had 3 or 4 years of pent-up distressed debt that was piling up on these banks' books get released out in the market. And so we put together a deal that where my partner Joe and we ended up making out really well. And we've just been kind of riding that wave ever since. But you're spot on, Brandon. That we had that big bubble of
Hmm.
product, and
Yeah.
it's since kind of dwindled down. But I would suspect here in the next, maybe 18 to 36 months, we might see another bubble period because the economy's a little rocky right now.
Yeah.
People are really kind of maxing out their debt, their credit card and their mortgages.
Right.
The wages are still going up, which is good, which should help people stay current. But there's starting to see some little cracks here and there in the market, so that business might have another bubble here in the next couple of years.
Yeah, it sounds like y'all are watching the regulations and the laws and stuff because that's okay, yeah, this
Yep.
this this law just went into place. The lending's looser
Hmm.
4 or 5 years later. All right, we're gonna reap the benefits of it.
Yep.
As far as trends that you're seeing in inflation in real estate, this is a hot topic that I want to talk about, and I know you're an
Hmm.
expert on it. Inflation's the big thing, right? You've
Sure.
got inflation, which is good for real estates, but it also influences interest rates, which are going up, which is bad for
Hmm.
real estate. So you've got these humongozoid forces that are kind of pushing on each other. I describe it as you've got this glass box where you've got these just like metal balloons that are being blown up and they're pushing on each other, and one's going to pop immediately, and when they pop, it's all going to kind of like shift pretty radically. For investors out there, business owners,
Mhm.
entrepreneurs, what are the trends in inflation right now in regards to real estate investing? Like, where are you seeing some of the opportunities to take advantage of inflation?
Sure. I think in the larger scheme of things, Brandon, I mean, real estate goes in cycles, right? So and not just real estate, but lots of things, right? So my first experience with an investment bubble was back in the early 2000s when the internet first was coming online, and we had this huge bubble, and then it popped and things crashed, and then then we had another bubble leading into the Great Recession, 2006, 2007, had that bubble. And so these things tend to they go in cycles. So I think as an investor, I think it's important for people to see that there's ways to make money in every market. And I think a big mistake people make is trying to time things. So, like in our Belrose storage group, we started buying facilities in 2020, and we had a great run up, and now things have kind of come back down and are more normalized because of the increase in interest rates and inflation, like you were mentioning. But we've been out there. We continue to buy, and what we've experienced in the past is those investors and those operators that stay active and they stay in the market and they keep investing through these cycles. They're the ones that make out the best, because you just can't predict the future, right? Well, we're not in the business of predicting interest rates, so we're in the business of operating self-storage facilities. And so what we do is we control what we can control, right? We can't control the economy. We can't control interest rates, but we hunker down and we focus on our operations, making sure that we're using the latest and greatest technologies, the latest and greatest, software, and we're just really, sharp with our operations aspect. But as far as, inflation, like that definitely, like you mentioned, has been a double-edged sword. We had a nice run up, which in self-storage, as compared to some other asset classes, we can literally change our rates on a daily basis. Our customers lock in for a month long lease at our facilities. So we could theoretically change their rate every month if we wanted to. So if inflation's pushing up everything, including rental rates, we in theory could push up our rates there every month, which is great. But to your point as well, with interest rates being higher, it makes deals tougher to pencil. More of the return is now going to the debt side than the equity side, and so it makes it tough for some of those deals to work out. So we've been unfortunately having to walk away from a bunch of deals, but we're also closing on some deals. We've got a couple closing up next week, and we closed one last month, and so we're still very active. And I think in the long run, because real estate's a longer term play, it's not a get rich quick scheme.
Mhm.
So as we acquire these facilities, we implement our value add strategies and our management platforms. We can ride out this trough that we're in, and when the cycle does come back up and around, which it will, I don't know exactly when, but it's gonna.
Yeah.
Then we can reap the rewards at that time. But right now it's time to hunker down, and for our investors, it's smart to put money in a hard asset that where your capital is going to be preserved.
Mhm.
It's not going to go to zero. So, like some of my internet stocks did back in the early 2000s.
Yeah.
So, I mean, that's kind of where we're at, Brandon.
Well, so what are some of the mechanics behind inflation that's driving the success of these hard real estate assets, right? Because, inflation affects a lot of things, right? If I'm going to go build a building and the cost of materials have gone up, well, I'm hoping by the end of it that the value of the building has gone up too, right? Inflation
Sure.
is going to also increase your rent per month, which
Hmm.
is going to drive up your net operating expenses, and hopefully your expenses don't,
Hmm.
go up at the same rate that your rent does. So, like, what are
Hmm.
some of the forces behind inflation that's specifically driving the success of these hard real estate assets?
Yeah, well, sure. Well, you just listed a couple of important things, which are like material costs and that sort of thing. But one thing you skipped over is wage inflation, right? Wage inflation is really persistent, and that's a good thing and a bad thing. I mean, what's causing, and look, I'm no expert, but from what I read, the Fed is going to have a hard time cutting interest rates until the wage inflation kind of calms down because the market for talent right now is still really hot. Wages are still persistently increasing, which is good because that means folks can afford the higher rent at their apartment or at their self-storage unit. So that's a good thing. Eventually, though, it's gonna catch up because we also have energy inflation. Energy is still getting more and more expensive. I don't know. I'm sure folks out there going to the grocery store, you see groceries are getting more and more expensive. So it's like everything's kind of moving up. But yeah, it's one of those things, Brandon, where a lot of these factors are moving in the same direction. And we're just trying to keep our eye, like I mentioned before, on the things that we can control, and just manage our business accordingly.
So let's jump into it. You've been a part of short-term rentals. You've done the distressed debt investing, mergers and acquisitions. You got a very extensive background, and I know you are seeing an opportunity in self-storage. Tell us more about that opportunity and what's driving you towards it.
Sure. Yeah, so as I mentioned, we've kind of dipped a toe in a few different asset classes, because our distressed mortgage debt business is very volatile and unpredictable. And as an MBA guy, I like to do the business plans and have the key performance indicators and all that stuff. But we just couldn't do it in the distressed mortgage debt business the way that our business evolved there. So we had been searching for an asset class that was going to be nice and steady, generate some cash flow, and have some depreciation benefits and those kinds of things. And as we looked around, we started learning about self-storage about 2017, 2018. We started going to conferences, meeting the people, learning about the asset class. 2019, we joined a mastermind group in self-storage where we were learning from operators that were actually owners of facilities. They were investors like us, and they bought these facilities. And what were they having success with? What were they having challenges with? And when we really dug into it, Brandon, there were a few. I mean, there's a lot of things, but I would say probably the biggest three things are number one is for the past like 40 years, self-storage occupancy rates at facilities across the country was kind of gently meandered between about 80 and 90%.
Mm-hmm.
So if you think about that, just think about the different things that have happened over the last 40 years. I mean, we've had booms, we've had busts, we've had wars, we've had terrorist attacks, we've had pandemics, we've had all this stuff, but self-storage just continues to just sort of bump along between 80 and
Yeah.
90%. So for us, it really gave us a good feeling about how steady this asset class was in all different kinds of economies. It reminds me, Brandon, I don't know if you go to the water park at all, but a lot of people like to do those big, steep slides where you get the water up your nose and in your ears and in your eyes, and you end up with a wedgie at the bottom. You'll find me, Brandon, on that lazy river going around the outside where I'm sipping my cocktail, holding hands with my loved one, catching some rays. That is self-storage to me. It's just that nice, easy, steady flow. So
Steady.
that's what I like. Another thing I mentioned capital preservation a minute ago. If you look at default rates on loans in commercial real estate, you know, hotels are way up there, retail's way up there, office, right? Nobody's going back to the office, so a bunch of those loans are defaulting. Multifamily is super solid. Self-storage, it doesn't even show up on the chart, Brandon. Self-storage facilities do not default. So as an investor, I really like to see that, especially having lived through the Great Recession. Because
Why is
again,
that?
well, I'm glad you asked. It's because the operating model at a self-storage facility is very, very efficient. What do I mean by that? So let's compare. So $100 of rent comes into an apartment building, right? By the time the operator pays the property taxes, insurance, utilities, upkeep, management fee, et cetera, they might have about 35 bucks left over to pay their debt service and hopefully have something left over to pay their investors. Self-storage is the opposite. $100 of rent comes into a self-storage facility. Our taxes, insurance, utilities, upkeep, management, etc., adds up to about 35 bucks. So we have $65 left to pay our debt and pay our investors. So because of that efficiency, Brandon, it allows self-storage facilities to keep up with their debt and also pay their investors.
Wow. So yeah, there's plenty of money left over, and I love
Yep,
how insulated this asset class is because people are always going to need storage if they move or they're downsizing, et cetera. And when you get these
that's right.
recessions, that's what people do. They downsize, and you got to do something with your stuff. So what do?
Yep,
Stick it in a $50 to $100, $200 a month, whatever storage container to take care of your stuff. What
that's
does the
right.
future, and I want to make sure I give you time. Was there any other points that
Sure.
you said there was three main things that was
Yeah,
driving you to this?
I did. I gave you two. The third one, actually, I mean, you mentioned the future, right? So the third one has to do with that. So market penetration for self-storage. What does that mean? Well, it's demand. So you look back a few years ago, maybe 5, 10 years ago, the market penetration for self-storage was about 8% of 7, 8% of households around the country were using self-storage. Well, now it's about 12%, and it's increasing as our population is increasing and as people are seeing self-storage as basically an addition to their overall housing strategy, right? So I know maybe 8% to 12% doesn't sound like a lot, but when you consider, Brandon, there's 120 million households in the country. Every 1% move is 1.2 million new self-storage customers. So from going from 8 to 12, that's 4,800,000 new self-storage customers. And guess what? They're just not building them fast enough.
Yeah.
And municipalities, I mean, this as a developer. I mean, municipalities are tough, and they might be cool with one of your residential developments, but
Yeah.
a lot of municipalities are not big fans of
It's not sexy.
self-storage. It's not sexy.
Yeah.
It doesn't create a nice tax base, those kinds of things. So the supply of self-storage is
Yep.
being dampened while the demand for self-storage is cranking up. And so we love to see that supply and demand in balance because it means we're going to keep our facilities occupied and we're going to be able to push rates.
100%. I couldn't agree more. And it's funny that you mentioned that. I would encourage people to go look at performing asset classes in real estate. Self storage is continuously at the top of it. As
Mm-hmm.
long as you can find a good operator and make sure you've got one that's cash flow in a good area. And it's kind of funny. I didn't know about the default rates though, because as an
Mm-hmm.
investor, you really want to be paying attention to what your money is in. And because if you get, a default, well, that could be a 100% capital loss, right? So capital preservation, number one thing you should look for, make sure that your money is going to be protected and you're going to get it back. Can't stress that enough.
Yep. 100%.
And whatever business you're putting your money in is the business that you're in. I think a lot of people don't realize, like, as a landlord, if you're an investor and you're investing with Tom, or you're investing with Brandon, whoever you put your money is, if there's a tenant involved, you're in whatever business the tenant's in. And so make sure you keep that in mind. I love all this stuff. Tom, for those listening that want to learn more about you, learn more about your opportunities, where can they go?
Sure. Yeah, it's been great, Brandon. Again, I'm Tom Dunkel. I'm Chief Investment Officer here at Belrose Storage Group. You can find us at belrosestorategroup.com. Or if you Google me, Tom Dunkel, I've got a lot of stuff out there on social media, podcast interviews, value add articles for our investors out there. So you can definitely find us that way. And, we're super excited about the self-storage industry, Brandon. We've got some niches within the self-storage niche. I know we didn't get time to get to today, but if investors out there are interested in some of these amazing niches where we're seeing tons of opportunities to make great returns for our investors, by all means, reach out, and would love to chat with you more about this.
Hey, thanks for sharing. We'll make sure that gets posted in the show notes. Tom, it's been a pleasure having you on today.
Thanks, buddy. Great to be with you.
And hey, if you got value from this episode, show Tom some love, show me some love, leave us a review, like, and subscribe to this, share it with your friends and family, and we'll see you next time.